Okay. I hand it over to you, Chair Royce.
Okay, thank you very much. I'd like to call this meeting to order. It's November 3rd, just after 4:30 p.m. This is a special meeting of the Finance and Audit Committee. My name is Roger Royce. I'm the chairman of the committee. I'd like to do a roll call since I can't see you on my device. Could I just get a shout out from who is here in attendance that is on the committee?
Vice Chair Westcott.
Yes, Vice Chair Westcott is present.
Committee Member Wong.
I'm here. Hi.
Mayor Combs. Councilmember Mueller.
Here.
And Chair Royce. And Committee Member Normington.
Here.
Great, thank you.
Okay.
Back to you, Chair.
Okay. Thank you, everybody, for being here. You should have gotten a copy of the agenda. And you'll notice on the agenda, we have a handful of items for this special meeting, both regular business and consent agenda, including establishing a subcommittee on social responsibility, a request for periodic reporting of net revenue by geographic area, and then to approve some minutes and approve a special meeting date. And we also have subcommittee reports today, and I have gotten reports from 2 subcommittees. So before we get into that, I think the next item on our agenda is going to be presentations. I'm into D1, the Insight Investment City of Menlo Park Investment Report. So Nick, I gather you'll take that.
Yes, thank you, Chair. We do have our investment advisor, Dave Whithone from Insight Investments. His presentation was published in the packet for tonight's meeting, and I will project that here in a second. Dave, please introduce yourselves and we will get rolling.
Well, good afternoon, everyone. For those who are not familiar with Insight Investment, we're actually part of Bank of New York. We're their investment advisory subsidiary that works with public sector clients on their operating portfolios. We also do quite a bit of pension work. We have offices primarily in New York, downtown New York in Midtown, and but we also have a big hub in London to service our European clients, and also in the Far East in Australia and in Hong Kong. So with that, let me just kind of run you through. We're going to do a piece of our portfolio on the economy and what's been happening recently, what our expectations are moving forward, how we've planned our portfolio strategy to execute on what we see in the economy. Talk a little bit about portfolio performance and how we structured the portfolio right now. And then we're going to talk at the end about ESG. And it's a very hot topic here in the United States. It's actually been going on for quite some time with our European clients, and since really back in 2006 when the UN resolution came out. So with that, let's move down to the first graph. I think it's on page 6. Oh, that's perfect. Thank you. Thanks, Nick. Look, you know, we've all seen economic activity picking up rather dramatically since the latter half of last year. Household net worths are up. That's not only from just the stock market going up, but it's also from the fact that you know, real estate's been going up right along with it, but also 2/3 of the stimulus checks were actually put into savings. And we're going to see another slide on that later on. So people are flush with cash and they haven't been spending a lot. Sometimes they were in lockdown and they didn't have any places to spend it on. Now spending on services has still not reached where we were pre-pandemic, but spending on goods is certainly up. The problem is, as we can see in the middle graph on delay times, getting goods into the country. Most of the supply chain is built on just-in-time management anymore. And it's not built on surge management. And what we had in the last 6 to 9 months has been pretty much a surge in demand, particularly for goods. Things like automobile inventories are at an absolute rock bottom. The other thing that's been very difficult and challenging in the economy has been getting workers. And you can't go anywhere really around that doesn't have a help wanted sign out. And getting workers and getting skilled workers too. There's a lot of competition for both skilled and unskilled workers. So job openings are at an absolute all-time high. We're adding new jobs to the economy, and we've been adding them, but we're adding them slowly. We just got the ADP report from the payroll processor, ADP, out this morning. They think that new jobs were added somewhere around over 400,000 in the month of October. We're going to get the Labor Department's numbers on Friday for non-farm payroll. The numbers are supposed to be about 400,000. Our people think that they may actually be, conditions might be right to add even more than 400,000 new jobs on Friday. So the economy's been strong. Let's drop down to the next slide, Nick. Unemployment's been low. As you can see on the slide on the left, unemployment rate now dropping down to 4.8%. Before the pandemic started, we were running at 3.5%. And that's one of the Fed's mandates. Keep in mind, stable prices and full employment. And they see full employment being back to the level that we had before the pandemic started, which is about 3.5% unemployment. They think we're going to reach that number. By the end of the year, we're going to probably be at about 4% unemployment. And they think that we're going to reach full employment if we continue to add the jobs at the pace we're adding them currently, sometime late spring, maybe June of next year. So we're closing in on the Fed's desired level of employment, and that's good. We have had some problems in participation rate. Some people are actually dropping out of the workforce. Some people are retiring. Some people leaving. We saw this in New York City. A lot of younger people left the city that had jobs in the city and went home to live with their parents, and younger people. As you can see, some people in that 20 to 24 age group, they simply went back to work living with their parents, and they haven't, some of them haven't entered back into the workforce just quite yet. So let's drop down another slide. This is a slide I was referring to earlier when I was talking about saving some of that stimulus money. We're projecting that we have about $3 trillion in excess savings. Some of that's stimulus money. Some of that was unemployment benefits, and some of it was just not having places to spend money on. And people haven't been traveling as much. They haven't been buying services as much. Goods, as you can see on the consumption on the graph on the right, goods are actually up. Good consumption is up, and that's part of the supply and backlog problem that we're seeing down in the ports of Los Angeles and Long Beach. Good consumption's up, but service consumption, which by the way is a much larger portion of the economy than the goods portion. The service section portion is a bigger chunk of the economy, and that's still far below where we were pre-pandemic. So let's drop down another slide. But that demand, particularly the demand for goods, has led to one thing. When you have limited supply and you have increased demand, you're going to get inflation. And we haven't seen inflation like this in over 30 years. It's been a long time. Inflation before the pandemic we thought we might be in some kind of a deflationary period because the Fed was trying to get inflation back up to their 2% target. And as you can see, back in 09, 11, 13, 15, it was running well below the Fed's 2% target level. And now the CPE, which is a personal consumption expenditures, which is the Fed's preferred measure of inflation. It's the one they use to change nominal GDP to real GDP. That's been running around 4% right now. And CPI, which is another, consumer price index, that's another very popular measure of inflation, has been running at over 5%. We thought it would start down by now, but those supply problems have been rather persistent. We haven't been able to get chips in for automobile sales. And so that really does have inflation running pretty hot. And the Fed announced today that it's going to start tapering. I mean, they've been doing quantitative easing to stimulate the economy, and that means they're buying bonds in the open marketplace and putting cash back into the market for liquidity purposes. They've been doing that to the tune of $120 billion a month. They've just came out today, said they're going to start this month tapering, and they're going to reduce their purchases by about 15 billion a month. And so by next June, they'll be stopping the quantitative easing. And so that's the first reduction in stimulus that they're going to do for the economy. And if the economy survives that, which we think it will, they're actually going to then be contemplating about raising interest rates. How soon they start to raise interest rates will depend on just how persistent this inflation is. Is this inflation, as the Fed is calling it, transitory, which means it's going to stick around for a little bit of time, but not forever, and it's not sticky inflation, what they call sticky inflation, but these are items which can reverse in price rather quickly. So when the supply issues clear up and the demand and supply get more equalized, which we think will happen in the spring, we are projecting that inflation should come down. Is it going to go right back down to the 2% level that's the Fed's target? No. By next summer, it should be probably around 3%. Still running a little high, but the Fed may be willing to run the economy a little hot for a while rather than going right into an interest raising cycle. But we are prepared for interest rates to go up, and they have been rising just recently. In fact, as the market prepared for the tapering, we did see short-term rates in particular, which is the part of the yield curve that we invest in for the city, because it has to be securities 5 years and under, all fixed income. And that part of the maturity spectrum has gone up, rather significantly, even since the end of the month of September. Let's drop down another slide, Nick. Our outlook, our GDP outlook, we've trimmed it back a little bit. We just got third quarter GDP. It was decidedly soft. It was only 2% GDP growth in the third quarter. However, a lot of that was from a downturn in auto sales. If you backed auto sales out of the equation, GDP was running at 4.7%. So GDP is actually still pretty strong, but the auto industry is really hurting simply because they can't get the chips to put in the automobiles. And I can't remember the number of chips that's in the average automobile, but I think it's like 30 or 40 chips per automobile. And so they really have, these computer chips are really running a lot of the functions in a lot of the cars, and nothing's, of course, analog anymore. The good news, though, however, about the slowing economy, because the GDP was running at 6.7% in the second quarter. So the moderating in the economy for this year, and we think it's going to average this year around between 5 and 5.5% GDP growth this year. Next year, we're projecting about a 4% growth in GDP for 2022 and 3% growth for 2023. Now, keep in mind, you say, okay, well, the growth's slowing. For a decade before the pandemic started, the average GDP growth was 1.9%. So if you think of that as the long-term average, somewhere around 2% is the long-term average, we're still running a pretty hot economy. We're going to run a very hot economy this year. We're going to run a reasonably hot economy in 2022, and still an above trend growth economy for 2023. So things are looking pretty good economically. And if we can get the inflation under control, that will mean people's purchasing power will actually increase. Let's drop down another slide, Nick. So how is the performance on the portfolio? We're going to look at this in a couple different ways. Well, this is sort of the long-term performance on the city's portfolio. One of our benchmark targets is always the 2-year treasury, because you can have a range of investments between 1 and 5 years, or 0 and 5 years. You can go out as far as 5 years, and about that average in the middle is somewhere around a 2-year treasury. And so we use that as one of our benchmarks. And how's our performance been doing? Well, when interest rates were rising in 17 and 18, we were lagging behind the 2-year treasury because it's a term portfolio and we have to roll securities off. But since 2019, even before the pandemic, we were surpassing the 2-year treasury. And of course, since the pandemic, we've really outperformed the 2-year treasury. So our performance has been pretty solid, particularly in the last couple of years. Now, we also do a benchmark against a fair value benchmark against the Merrill Lynch 1 to 3 year treasury index. You can see the city's portfolio is the dark line, and it's a little bit less volatile because we've generally been running our durations a little shorter than the index, and that's caused a little bit less volatility. But our performance is still very good versus even the 1 to 3 treasury index, even though we've tended to run our durations a little bit shorter than the index. Let's drop down. Here you can see the portfolio growing over time. It just has consistently grown over that time period since 2016. Here's the slide on duration is just a little illustration of our active management. We had the portfolio duration up as high as 2% there for a while, or 2 years there for a while. We have been dropping it down in 17, 18, and 19 as interest rates were rising. We kept the portfolio getting shorter and shorter. When we reached the top of the interest rate cycle, in order to try and lock in some of those higher interest rates, we jumped the portfolio duration up to over 2 years. And now we've been starting to drift downward again as we're preparing for interest rates to start to rise again. And we're at 1.89 years. And that was at the end of September. We're actually about 1.8 years now as we meet here today. So we've been consistently bringing that duration number down. The benchmark target is about just over 1.9 years with a 1 to 3 treasury index. Let's drop down another couple of slides, Nick. Here's the performance on a year-to-year basis versus the 2-year treasury. You can see the performance of the city's portfolio when interest rates are falling and when they level out. The performance is always outperforming the 2-year treasury. Where we lag behind is when in like 17 and 18, when interest rates start to rise. It is a term portfolio, so it takes us a while in a rising interest rate environment to work some of the securities that are lower yielding out of the portfolio. As the portfolio transitioned in 19, we surpassed the 2-year treasury, and now we're in that phase where we're outperforming the 2-year rather significantly again. If you look over this entire time frame, we've outperformed the 2-year treasury by about 76 basis points over this time period. So that's pretty significant outperformance. You can see down the next slide is our on a total return basis. The difficult part on a total return basis is we tend to buy and hold securities. We tend not to be trading securities back and forth. So in order to capture like a 3% total return in 2020, in order to really capture that, we would have had to sell all the bonds in the portfolio, and that's not really what we did. So rather than showing a total return performance of about 3% in that period, we really made about 2% in terms of actual yield on the portfolio. And that's when you're looking at a budget, budgeting what you can actually earn, what the income is on the portfolio, is better than trying to budget the price movement, because the price movement goes up and down all the time. And but we are required by GASB 31, and the city's required by GASB 31 to mark the performance of the portfolio to market at least once a year. Let's drop down and take a look at the asset allocation of the portfolio. Here's the asset allocation of the portfolio. We have a small cash position in the portfolio. The biggest holding we have is in corporate bonds. And these are high grade corporate bonds. They have to be by statute A or better by at least one rating agency. And that includes all the A categories, A1, 2, and 3. So that's the largest holding. After that would be Treasury government agency securities. This is like Fannie Mae, Freddie Mac, farmer credits, home loan banks. And after that, government bonds would be direct Treasury bonds. So about just over 50% of the portfolio is in government bonds, and the other 40% is in high-grade corporates. Let's drop down another slide. You can see the maturity distribution within the portfolio. Right now, typically we would have a longer tail on the maturity distribution. We might have bonds out in the 4 and 5 year area. We might have a larger allocation in the 3 and 4 year area. Now we're compressing all of the bonds. By the end of this year, we won't have any bonds in that 3 to 4 category. All the bonds will be 2 to 3 years or less, and all the bonds will be getting shorter because we're allowing that portfolio duration to shorten up. That's because we anticipate rising interest rates in the future. We've picked up some interest rates. Interest rates have risen a little bit in the last month or so. We expect as we get further and further into the taper, and if inflation continues to be rather persistent, that interest rates could start, and we could have what we call liftoff from the Fed, which is to increase the overnight fund rate at the Federal Reserve by 20 or 50 basis points. Some people are calling that it could start as early as this time next year. We, however, think it might not start until early 2023. But we know higher rates are coming down the road, so we have to prepare for it. Let's drop down another couple slides. We have some holdings included in the packages, all the bonds and securities, but I wanted to drop down and talk about some of these securities in more detail in a couple slides down the way. All the bonds are in there, and we're not really too worried about any of the corporate credits right now. I will tell you that S&P was in our office last week, and one of the questions we typically ask them is, what's the current ratio of corporate bonds being their ratings increasing to decreasing, and it's 8 to 1. 8 to 1 in terms of corporate credit ratings going up as opposed to going down. So that's just an indicator that corporate health is very strong. Another indicator is what you're seeing in the stock market. We just got the corporate earnings season out. We're coming to the close of it. About 3/4 of the S&P 500 has reported. 80% of those are beating earnings estimates. And so earnings are relatively strong. That's why you're seeing a big pickup in the stock market recently. Let's drop down to the ESG slides. There's just too many slides here to go through all of them.
Okay.
Sorry about that.
Dave, if you wouldn't mind introducing ESG, I've been asked to switch to the PowerPoint version, so I'm going to go off screen here for a second.
Absolutely. So ESG. It started with responsible investing, and it was a UN initiative, and they came out in in 2006 with the principles of responsible investing. They call PRI. They asked investment advisors to sign on to principles of responsible investing. And Insight was an original signator to the charter. And we are actually rated by a UN rating agency that comes out and rates investment advisors on how closely they're following the principles. We've gotten an A+ rating every year, but not everyone gets an A+ rating, but we, because of our European business, have been very involved in it. And now this is evolved into responsible investing is involved into what the three main principles are: environmental, social responsibility, and what they call governance issues. And we've got some slides in the pack. Do we want to go through those slides, or do you want me to just sort of cover it in general, Nick?
Let's go through your slides. I'm sorry, I'm having some technical difficulties.
Oh, that's okay. But so we actually work with and hire index providers, and we rate, and we have a team of people who are on our ESG, what we call our ESG team, and they use external sources to gather information on every company that any one of our customers invests in, whether or not we're managing their portfolio on an ESG basis or not. And some clients simply don't care about it, and many more clients and many public sector clients it's now coming to more of a forefront. You see it, the Department of Labor has actually come out and started to speak about it, because there have been a lot of public pensions that are trying to manage their funds on a responsible basis. Now, I will tell you that we're in the fixed income business. Many of the people who are ESG providers are in the corporate equity business, and they're trying to work with corporations because they're equity owners and they're shareholders of the corporation. We are debt holders of the corporation, but we still have some influence. They still care what we think, and they still want people to buy their bonds. And so if we can slip down in there, Nick, to the ESG section. So we do have some influence. And, ESG started out as an exclusion, like, oh, we're not going to buy these bonds, or we're not going to buy those bonds. We're not going to buy energy bonds. And it's morphed into, we're not going to buy people who are bad with the environment. So here are the principles that are set out, that we as an investment advisor say that we're going to incorporate ESG into our investment process and decision-making process. One of the things we do look at it as is a risk. You look at someone like the Exxon Valdez, once they have problems, or even the Shell oil guys, our British Petroleum guys down in the Gulf, when they had oil leaks, there's big problems for the company. And so this is if they're not being careful environmentally, they can cause a tremendous issue for both the stock price and for debt issuance too. They can get downgraded. So those are the principles. It's too long to go over every one of them, but let's drop down another slide, Nick. Oh, so these are some of the things, because I think environmental things people get pretty easily, wastewater management, product footprint, where you're sourcing your raw materials, what's your carbon footprint, are you polluting through wastewater and pollution, and do you have good land use and carbon emissions in your factories? Environmental things we get. Social responsibility, I think people get too. Labor management, everything here in the light blue. Human capital, are you treating your people fairly? Are you treating your suppliers fairly? Do you have good customer relations? Are you treating your customers fairly? And then you get into probably a little bit more esoteric, which is the good governance area. Are you following anti-competitive practices? Because some of the people who were good citizens as far as environment and treating their employees well can also be tough on competitors, and they can have anti-competitive practices that are harmful to the industries. So is your board broad? Are you have good representation on the board? Do you have a diversity in the types of people who are on the board? Or do you have a lot of insiders on the board? Things like that, business ethics, pay, corruption. Have you been, have you had bribes overseas and that sort of thing? So they're following the lobbying policies and the accounting practices of all the companies. So those are the different areas. There's actually, if you drop down to the next slide, we put them in. This is our ESG framework. In each one of what we call the pillars, the environmental pillar, the social pillar, and the governance pillars, we break down the various categories into subcategories. There's 29 of them that our people measure, and we get data and collect it from outside data providers. They're down here at the bottom. The MSCI, Sustainalytics, and I can never say that name, and Vigoro Eris or something like that. But we also gather it from Bloomberg, but the Bloomberg ones aren't necessarily all as accurate as some of the. MSCI is really the leading provider for all the companies, and we weight probably their input more heavily than others, but we do have. It is subjective because all these influences can't weigh equally. And so, for instance, banks score very well environmentally because, they don't have a factory, but where they get knocked back is on their social pillar and their governance pillar. And so if they're not treating their clients fairly or their customers fairly, and you're having a problem, and of course, Wells is the poster child for this. I will say Wells is my personal bank, but and we do have Wells bonds, and for people who aren't ESG sensitive, we don't happen to have any in the City of Menlo Park's portfolio, but we do have them for other portfolios. And I will say, if they're not treating their customers fairly or they have poor customer relations, that's where they hurt in the social score. Now, it's a weighting, so it's not like an average. They look at the industry and they say, well, which of these scores should we weight most heavily? For a bank, they might weight in the environmental score, they're getting a 1. Okay, yeah, but we're not going to weight that very much because you're really not in a polluting industry. But we might weight the social score much more heavily or the governance score much more heavily. So it depends on the industry. So this, I'd love to tell you this is an exact science, but it's somewhat of an art too, even though you're going to see numeric scores on here. So let's drop down. We're running behind, so let's keep going down. One of the things I did want to show you is that this is one of the keys. ESG is absolutely in what we call our landmine checklist. It's one of the risks we really weight, and we have to, and every analyst, and we have to analyze every company before we do any investing in any of the company before they get on the approved list. They have to have an ESG score, and there has to be a discussion about it. Like I said, every corporate bond we buy is rated. Let's drop down. This is where it gets a little dicey. It's how the sausage is made. As I said, I don't think you can say it's an exact science. I think there's some art here. We're taking inputs from a number of different providers, getting them into raw scores, and then our teams are weighting those scores based on what they think is the most important factor for that particular industry. Let's drop down another slide. As you can see, this is for one company. It becomes, it's every company has a screen like this at Insight. And it's a complicated process. I'll tell you that. And it's complicated in the weighting of how they do it. And the weightings, let's drop down another point, because this is about the weightings. And you can see whether or not they're weighting, whether or not it's a key issue, and whether or not how much each of those key issues, which key issue it is, what their score was, and how much weighting that issue has in that industry. It's not easily understood, but let's drop down another slide. So here's the portfolio industry concentrations for the city, and and everyone's S&P rating and Moody's rating on all the bonds. And let's drop down and the percentage holdings. We tend to favor, I will tell you that we tend to favor the banking sector. One of the reasons why we've got 18% of our corporate holdings within the banking sector, or 18% of the portfolio holdings within the banking sector, is that they do favor pretty well on an environmental score. They suffer a little bit on the governance and social scores. They also tend to have a little bit better performance. The other industry that we do like is the tech industry. Although I will say that tech bonds are expensive in that they're in demand. Just like tech stocks are in demand, tech bonds are in demand. And so the premiums are pretty tight on the tech bonds. We do tend to favor, and we have about a 7% exposure in the tech industries. This is our next highest exposure after the finance industry. Let's drop down to that final slide, Nick. When we go in here, and this is just an overall of our ESG ratings and the Moody's and the S&P ratings, along with it, the individual bonds that we have, how each one of the industries are scored, both environmental, social, and governance. I'm sorry, we did get an error in here. Nick and I were talking about it the other day. Bank of America, their social score isn't a 1, it's a 4. We got it on the first bond, but on the next 2 bonds, we missed that. So their overall weighting is a 3, but their social and governance scores are both 4s. If you look and think of these as a normal distribution, the overall Insight score should be around a 3. We're at 1.93. So that would show you just a normal distribution for all corporate bonds. So we haven't been running the portfolio particularly as an ESG sensitive portfolio. If you were running the portfolio as an ESG sensitive portfolio, you would probably forgo anyone that has a total ESG score of a 4, concentrate more on 1s, 2s, and 3s. And let the 4s drop out of the portfolio. You only have 2 4s or 3 4s in the portfolio right now. Procter & Gamble, General Dynamics, obviously because of their weapons industries, and Walmart, mostly because of their anti-competitive practices and their workforce practices. So, like I said, we're perfectly capable of tracking all the ESG scores. What most of our clients who are looking at doing social responsible investing tend to focus on having better scores, above average scores, what they call best in class, so that you're looking for, portfolios that have 1s and 2s and 3s in them, as opposed to 4s and 5s. And with that, I'll open it up to questions. I know we've covered a lot of ground, but we certainly just wanted to show you our ESG capabilities and we can have a broader discussion about that should people be interested.
Back to you, Chair Royce.
Can you enable my video?
Sorry about that. Just 1 second.
Oops. All right, there we go. Okay, thanks very much for that report. Let's move on to our regular business. If we can. Nick,
Excuse
something?
me, Mr. Chair. While this is a presentation, the members of the public may address the Finance and Audit Committee on the presentation, either by using the raised hand feature or *9 on the phone. I will just sort of add for the benefit of the audience that the Finance and Audit Committee is not taking action on this item at this moment. There will be a subsequent staff report that does talk about exploring the study of socially responsible or social responsibility in the city's investment policy. And so that will happen as the next agenda item, the first regular business. So if there are any members of the public who'd like to address the Finance and Audit Committee, please raise your hand or press *9 now. One final call for public comment on the presentation by Insight Investments. Seeing none, back to you, Chair Royce.
Okay, thank you. So I'm into regular business now, and item E1 on the agenda. Establish a Finance and Audit Committee subcommittee on social responsibility in the city's investment policy. I guess I'd ask staff to give me a little bit of an explanation as to what the action item is on this today.
Yes, thank you, Chair. As part of the City Council's annual goal setting priority, as part of the Finance and Audit Committee's annual work plan development, the Finance and Audit Committee at their last meeting approved a work plan and sent it to Council for their approval. As part of the Council's approval, they did ask that the Finance and Audit Committee explore a matter that has been before the Finance Audit Committee in the past, which is to identify investment policy options that are somewhat similar, if not very similar, to the City of Berkeley's investment policy and some other agencies throughout California as well as the country, that takes into account the impact of a particular security on the overall health and well-being of both communities and the environment, as Mr. Whitholm had shared. As part of this, staff is recommending that the Finance and Audit Committee establish a subcommittee to explore this matter further. As Mr. Whitholm's presentation outlined, there are a tremendous amount of assumptions that go into this particular analysis. There is no one there is no model out there that is necessarily the right model. It really goes to identifying the priorities of the agency and then working with our investment advisor to establish criteria that can then be used to manage investments. One option that Mr. Whitholm identified is that if we use the built-in ESG modeling that Insight Investments has prepared, the one option could be that the Finance and Audit Committee recommend to the City Council that the investment policy incorporate some guidance that includes and perhaps even is limited to, although I think that needs additional study, that includes the ESG score for each security, that corporate security that Insight or our investment advisor is purchasing. So the recommendation tonight, this evening, is for the Finance and Audit Committee to appoint a subcommittee to study this matter more fully, return to the full committee for a discussion of the issue recommendation once the Finance and Audit Committee has the opportunity to review the subcommittee's work, ask questions, make changes potentially, and ultimately arrive at a recommendation for City Council, which can be a number of items from the committee recommends incorporation of a socially responsible investment criteria in the city's investment policy to no action. That would be the decision of the Finance and Audit Committee once you have all of the information. This is not a task that staff is currently resourced to support. However, I know that Mr. Whithones and his firm is ready to work with the subcommittee, and of course, staff will provide any support needed to move the subcommittee's work forward and ultimately arrive at a recommendation for the City Council.
Okay, so to be clear, our committee here is primarily a committee that addresses accessibility and transparency and reporting. So this subcommittee isn't being asked to make any recommendations on what the city should invest in, of course, as just to correct me if I'm wrong, but it's more to identify how these criteria might be presented as part of the information that the council gets. Is that right?
Yes, Mr. Chair, I would just add to that the Finance and Audit, one of the Finance and Audit Committee's responsibilities or charter responsibilities is to review the annual investment policy. And so to the extent, and the council has asked that the Finance and Audit Committee explore this issue. So in this particular example, I would say that in addition to communication of the ESG or socially responsible investing, that goes beyond just communication. It also goes into the policy formation that will be recommended to council.
I have two questions. One, so policy is fine. It wouldn't be specific investments. It would be what policy is being used. The second question is the timing on this. When would the report from the subcommittee, is expected to be delivered?
Excellent questions, Vice Chair. The annual investment policy is reviewed by the Finance and Audit Committee annually, typically in the July-August timeframe. The committee did complete its review. I believe it was in August this year, and the City Council approved it. So we would really work backwards from, I would say, July, looking at the Finance and Audit Committee's calendared meetings, and depending on how complex the matter is and when the subcommittee is ready to make that recommendation or bring that information to the Finance and Audit Committee for discussion. I would say that potentially if the subcommittee could get a good sort of understanding of the issue and identify the key points, perhaps report out to the Finance and Audit Committee, the full committee in your January meeting, and then potentially take action in your April meeting.
Okay, that makes sense. The April would be the action. Okay.
Any other questions or comment about this from the committee? If not, I think the next step is to seek volunteers to serve on a subcommittee that would want to take this on.
Mr. Chair, if I may, we do need to solicit
Open it
public
up.
comment.
Okay.
Yes.
All right, go ahead.
Thank you. So if there are any members of the public who are in attendance and would like to address the Finance and Audit Committee on the topic of establishing a Finance and Audit Committee subcommittee to study and explore the incorporation of social responsibility in the city's investment policy as requested by the City Council, please raise your hand or press *9 on your phone, and I will open up your mic at the appropriate time. So, Mr. Chair, we have one speaker, Mr. Pistorino, and I will open your mic here in just 1 second, and you will have the floor, sir. There you go.
I'm hoping you can hear me.
Yes, sir.
Okay, great. Thank you. My name is James Pistorino, and I'm a Menlo Park resident of more than 20 years at this point, sadly for me, dating myself. I do hope, because wasn't clear to me from the meeting presentation, there'll be an opportunity to address just general topics that are not on the agenda. I'm not sure if we've skipped that portion or well, but on this specific topic, I wonder whether or not the council, whether or not the committee or the council more generally have considered the question of whether or not investments based on anything other than expected rate of returns would constitute adoption or funding of different political points of view. I think in the city of Menlo Park, there are quite a number of people that are going to fall along the spectrum of what social responsibility means and does not mean. But I'll just try it at the most extreme example, were the city of Menlo Park to pursue an investment strategy of investing in only in companies that are aligned, I'll just say, with the Republican Party, I suspect that would have one perception by the public. Likewise, the same strategy pursued only in the investing only in companies that are aligned with the Democratic Party might have one criteria. So I do encourage the people to consider whether or not investment strategies based on anything other than expected rate of return, which could include other factors. For example, could include exposure to environmental claims, and the Exxon, was it Phillips in the Gulf of Mexico, could include those things. But for example, I know, for example, some of the criteria looked in the ESG criteria, gender and diversity and other issues like that, and what social responsibility is. I just encourage the committee members and the council more generally to consider that factor and whether or not making investment decisions on anything other than expected rate of return might constitute monetary support of opposing political views. Thank you.
Thank you, Mr. Pistorino. Again, this is the final call for public comment on the establishment of a finance and audit subcommittee to explore incorporation of social responsible investment in the city's investment procedure. Not seeing any additional hands. Mr. Chair, I turn it back to you.
Okay, thanks. Well, I believe we need a subcommittee would be the next step. And again, I'd ask the members of the committee if there's anybody who'd like to be on the subcommittee.
It's Westcott, I would volunteer.
Okay, Brian,
Correct.
be nice to have one more.
I'd be happy to do it.
Is that
Normington.
Matt?
Yeah.
Matt Norman.
Mhm.
Okay, good. Matt and Brian will be the subcommittee, and you'll prepare some sort of report that'll be available by, I think, January for us to
Right.
consider. Right.
So that would
Okay.
be our next regular meeting, I believe.
Yes, that's right. Although we may have looks like we're going to have a special meeting before then, but we haven't got to that yet.
Okay, but yes, January would be the first report.
Okay, anything further on this item?
Mr. Chair, if I
Yep.
could have a motion and second to establish the subcommittee with Vice Chair Westcott and Committee Member Normington.
All right, will someone make that motion?
I'll make that motion. Westcott makes the motion.
And what's the motion? The motion is to establish a subcommittee on social responsibility of Westcott and Normington. Motion's made. Do I have a second?
Oh, I guess I'll second it.
Okay, we have a second. All in favor? Say aye. Aye. Anybody opposed? Is that an opposition or in favor?
Yes.
Okay. So it looks like the measure passes, or the resolution passes. Okay, can we move on? Okay, let's go to item E2. Consider request for periodic reporting of net revenue by geographic area. Again, this is a staff report, so I'm going to ask staff to explain this one to me.
Thank you, Mr. Chair. I know that we have a hard stop at 5:45. I will make it as quick as I possibly can. Potentially this can carry over into the January meeting or even the special meeting if necessary. The item before the Finance and Audit Committee this evening is consideration of a request that we've received from members of the public to explore the geographic distribution of revenue and expenditure generated generated in the city of Menlo Park. Initially, the request had been first explored in 2019 through reporting of general tax revenue, specifically property taxes, sales taxes, transient occupancy taxes, business taxes, and utility user tax. One part of that analysis provided a sort of one view into the economic distribution of general tax revenue. As a result of the pandemic, for the last 2 years, we have not incorporated that analysis into the budget. However, there is a desire to continue with that. We are asking the Finance and Audit Committee to consider this request and to make a recommendation to the City Council on this particular item. Specifically, as we just sort of piggybacking on the previous presentation and discussion, specifically in the area of the assumptions that are necessary in order to perform an analysis of net revenue. And net revenue is defined as revenue less expenditure by geographic area. Revenue, if we look strictly at revenue, it provides one perspective of the city's finances. However, it does not provide the complete perspective. And in order to address some of the complexities of our expenditure budget in particular, but also on the revenue side of our budget, there are a number of assumptions that will need to go into place. For example, on the revenue side, we do not have access to utility user taxes by geographic area. The utilities will not provide that information to us, so an assumption needs to be made or a methodology needs to be established to allocate those particular revenues in some way to the various geographic areas. For items like sales tax and transient occupancy tax, we do have the situs for those revenues, as well as for property taxes, but not all property taxes. There is a question about how we allocate investment income on the revenue side and a number of other general revenues. On the expenditure side, it gets significantly more complicated because the city's expenditures are effectively housed at 2 locations. The main campus off of the Burgess campus off of Laurel Street, and previously at the Annetta Harris site in the Bellhaven neighborhood. And so how and residents from all over the city use both of those facilities, and the question then becomes how do we allocate those expenditures in a reasonable and transparent manner, so that when we look at the expenditures that are netted from the revenue, that we have a reasonable picture of whether, of where each geographic area derives its generates revenue, so to speak, for the city, and then requires expenditure. And so with that, this is a significant sort of workload, again, an issue that that staff is not, it does not have the resources to prepare. We are going through a number of transitions in admin services and administrative services, which includes our finance department. And the reason I brought this forward to you this evening is that I want to make sure that the item begins the discussion, particularly as we approach our budget season for 2022-23, which for the most part wraps up in terms of graphs and tables, financial information that typically wraps up in April. And so if the committee is open to exploring this and supporting exploration of this request from a resident, then we will advance it to council and to city council and seek their approval.
Okay. Is this one that you want to open up to public comment as well?
Yes, thank you, Chair Royce. So if there are any members of the public who would like to address the Finance and Audit Committee on mapping the geographic distribution of net revenue, please feel free to raise your hand or press *9 on your phone to make public comment. Our first speaker is Mr. Pistorino, and sir, your microphone has been unmuted.
I'm back again. Again, this is James Pistorino, and I'm speaking solely on behalf of myself. I think actually, in my view, at least, the starting point for any analysis like this would, I assume, be the budget that was adopted for 2021, 2022. And I want to just, with regard to this committee and its charge, I think, with transparency, is I know one thing that I've been looking into recently is trying to determine what the budget was for 21, 2022. And on the, at least as I can tell, on the City of Menlo Park website, there is no provided budget for 2022. And I think, Mr. Pagueras, I think I've sent an email to you maybe 2 weeks ago now, asking that the website be updated so that the public can see what the actual adopted budget was, that I assume would have revenue projections in it that might relate to the regional distribution. So my starting point would just be that component of things. And I'll end it there, but I do hope, and I'm not sure if we've missed it, and I understand there might be a 5:45 hard cutoff, that there might be an opportunity for the public to just address the committee more generally on transparency issues. Thank you.
Thank you, sir. Final call for public comment. Either raise your hand or press *9. Okay, seeing no further public comment, Mr. Chair, I turn it back to you.
Okay, so do we need a resolution on this or an approval? What action are you looking for from the committee on this item?
Yes, the action for the Finance and Audit Committee is to, if we're looking for a motion, the motion would be to approve recommendation to the City Council to explore the mapping of net revenue by geographic area for the 2022-2023 budget.
Okay, so the motion is that this committee recommend the City Council that we explore periodic reporting of net revenue by geographic area for 2022-2023 budget. Do I have a motion? Does anyone want to make that motion?
Could I have a point of clarification? And the work, though, to do that would be carried out by city staff, correct?
Yeah, so very similar to the very similar to the last item. However, we are looking for the expertise of this group to help on the particular communication of this particular item. And so in order to do that, we need, as Mr. Pistorino had mentioned, we do need to be very transparent in what is included and what isn't included. And so, you know, I would see it as a joint effort between the committee and staff to identify which line items might be applicable, which items aren't applicable for a variety of reasons, and then working to document those assumptions for public
Yeah, right.
consumption.
So
You know,
you need a framework, and then you would need to do the work to fill in the framework. Okay.
Correct.
I have to believe that OpenGov software would be able to gather that data, would be able to provide those reports.
Correct, Chair Royce. There is an element of the Finance and Audit Committee's adopted work plan, which is to improve the accessibility and usability of the city's budget platform, which, speaking to Mr. Pistorino's specific request, the adopted budget is available on OpenGov. We have not prepared or completed preparing a budget book yet. It was a change that we made in fiscal year 2020-21 to move to a dynamic reporting system that allows members of the public to basically choose their own adventure as they're going through the city finances. What we've learned through this process, however, is that OpenGov does require a considerable amount of translation for the general public. It may make sense to city staff because we understand how our finances are structured, but the Finance and Audit Committee has established a subcommittee to work on that transparency. Unfortunately, OpenGov cannot, once we provide the model, once we actually hard code the model into the system, then we will be able to spit out reports on a regular basis. But OpenGov cannot do that, cannot identify the assumptions that are necessary in order to do
Okay, I understand. So that makes the motion necessary. Any action necessary so that you can tell OpenGov to provide that information. So again, does anybody want to make that motion?
Yeah, I'll make the motion to, so the motion would be to review the request for periodic reviewing of net revenue by region. And I would add and include reviewing how OpenGov could contribute to that reporting.
Okay. Do we have a second?
I'll second that, but just to clarify, it's just reviewing, right? We're not proposing anything or asking for specific changes to how the information is currently organized.
Well, Brian made the motion, so I'll let him address that.
I would say, as we talked about, we would have to provide a framework for how that information would be calculated, let's say, or determined. But the staff would then have to do those, determine and calculate in that framework. And then we're suggesting further, hopefully, that at some point that could be hard coded or added to OpenGov. So then it's calculated on a periodic basis as part of that system.
Yep, I second it.
That's a long, sorry, but
Okay, no, we understand. So we have the motion, we have a second. All in favor, say aye.
Aye.
Is anybody opposed? Okay, passes unanimously. Okay, Nick, can we move on to the consent agenda?
So
First-
at this point, if I may, Mr. Chair, solicit any public comment on the consent agenda, which is to approve the minutes and to schedule a special meeting for the review of the city's financial statements at a date to be determined by the Finance and Audit Committee. So if you'd like to make a public comment on either of those items, please raise your hand or press *9 to raise your hand by phone. Final call for public comment on the consent agenda. Seeing none, back to you, Mr. Chair.
Okay, thanks very much. I assume everybody's had an opportunity to look at the minutes of the August 2nd special meeting. And I do believe that we will need a resolution approving those minutes. So could I get that resolution?
Make a motion to approve the minutes.
Okay, we have a motion. Is there a second?
I'll second Westcott.
And I believe we should have some discussion if anybody wants to discuss it before we vote. Does anybody want to discuss changes, edits, deletions? Okay, I'll call the vote then. All in favor?
Aye.
Aye.
Aye. Anybody opposed? Okay, the minutes are approved. Let's move on to item F2. So I'll ask staff if we need public comment on this one as well.
Now, Mr. Chair, we took the public comment for the full consent agenda. What I would ask, though, is for senior or interim Finance and Budget Manager Patricia Barboza, who's been working tirelessly on the annual fiscal year-end close, as well as preparation of the financial statements, to share with us sort of the latest timeline on when the financial statements will be available for the Finance and Audit Committee to review before they are issued and before they are transmitted to City Council.
To be honest, at this time, it's very difficult to determine when exactly, but we can put an estimate probably somewhere in June, we will be able to bring up the maybe the first and the second quarter of the 2021 and 2022. Because at this point, some of us is still learning. We not all fully capable to operate the new OpenGov. So far,
Excuse me.
probably.
I'm sorry, Patricia, because of the timing, I just wanted to the request is, when will the financial statements be available for the fiscal year ended June 30, 2021? What we're working on right now. When will those be available?
2021.
Yes.
Well, 2021, we discussed with the auditor. So far, they said that they are going to give the 2021 before Thanksgiving. However, we still not sure with the time exactly when. Hopefully, it is really before Thanksgiving, but could have been a little bit after. We don't know yet, because we all still working on it.
Okay. Thank you. So through the chair, I would hopefully I would ask that the Finance and Audit Committee allow us to circle back as we get closer to issuance of the financial statements, to schedule and pull the committee for a special meeting, likely the week of November 30, unless there are any conflicts that may present themselves on that week.
Okay. Sounds.
Okay,
Thank you.
but we can pencil in the week of November 30th then as a potential. Okay,
Well, you can't for me. The week after that would be okay.
okay, well,
This would be the week of December 6th.
Yes.
Okay. Unless there are any conflicts there, we'll target the week of December 6th.
All right.
Thank you.
Okay, so I'm going to move on. We have some informational items. I want to thank the subcommittees for providing me with the reports on a timely basis. We have two of them. One from Normington Wong, it's on the OpenGov Portal Improvement Subcommittee report. And we also have the report on the capital improvement plan that Westcott and I had put together. Because of the timing, what I'd like to do is maybe defer a discussion of this until our next special meeting, especially since it's coming up within the next month. Is that okay with everybody? Alternatively, I will drop off and turn the meeting over to Vice Chair Westcott if you want to discuss these two subcommittee reports.
okay. I'll propose a motion to defer if we have to make a motion.
All right.
I'll
Motion
second
made.
that.
Second. All right. Is everyone in favor?
Yeah, no problem with that. Yeah,
Okay, thank you for that. I moved my flight once to make this meeting. I don't want to have to move it again. G2 is a director's report. Staff, is that long?
Yes. No, I'll make it very brief. As I mentioned earlier, the Administrative Services Department, which includes finance, is undergoing some transition right now. The city manager has named our previous human resources manager as the interim administrative services director. She will begin on in about 2 weeks in that new role. What that means is that the management of that team comes off of my plate and goes to her, and you will, she was unable to join us this evening, but she will be at your next meeting in December.
Okay, thank you. Is there anything else? Any other public comment that's required? Anything like that? Okay, then I'm going to move to item 8, adjournment. Could I get a motion to adjourn?
Motion to adjourn.
Second,
I'll second that, Normington.
all in favor?
All right.
Aye.
Okay, hearing nobody opposed, we are adjourned. Thank you very much.
Thank
All right,
you.
thank you. Have a good flight.
Thanks. Bye now.
Bye.